Welcome to my channel here on The Last Investor. My name is Dan. Thanks for joining me. I want to do a new twist to my stock analysis videos. So rather than carrying out an analysis of individual stocks, I'm going to analyze a group of stocks which are grouped together by sector. I used a Freetrade app, and Freetrade started to group stocks into sectors, so I thought, why not do a comparative analysis of those stocks as grouped by Freetrade, and so here we are. First off, just to set out the criteria that I'll be using, this is a purely quantitative analysis focusing on the income statements, balance sheets and cash flow statements for each of the companies. I'll be using some tried, tested and trusted ratios and metrics. But do bear in mind that no one metric is perfect, and companies will always find ways to make their figures look good, figuratively speaking, of course, no pun intended there. Also, it is important to bear in mind that whilst companies might be in the same sector, their businesses could still vary significantly, so this isn't always an apples to apples comparison. I will be analysing 4 distinct aspects of each of these stocks, namely balance sheet, profitability, dividend safety, and finally valuation. For the balance sheet test, I'll be using 2 types of metrics, namely debt to asset ratio and solvency ratio. For the profitability test, I'll be using 2 metrics, namely revenue growth and return on assets. For the dividend test, I'll be using dividend growth in years and payout ratio. And for the valuation test, I'll be using the PE ratio, which is also known as the price to earnings ratio, and I'll also be using the EV to FCF ratio, which is also known as the enterprise value to free cash flow. And finally, the third metrics I'll be using for the valuation test will be the discounted cash flow model. I'll be using a website called Guru Focus, as they have a really comprehensive data on their website for carrying out this particular type of calculation. So I rank each stock from first to last by awarding the top stock 10 points and the second stock 9 points, and so on. So at the end, I tally up the scores, and the stock with the highest aggregate score theoretically is the best across those group of stocks. So hopefully you will find this as interesting as I have found putting this all together. So as I said, for this video, I'll be analysing the logistics sector. Freetrade have 4 stocks under their sector heading of logistics, as can be seen on the screen. They're basically Clarkson, Fedex, James Fisher & Sons and UPS. But from my thinking, these do not really appear to be like-for-like companies, and I did a little bit more digging, and what I can see on the website for Craftco is that these are not direct competitors. In fact, FedEx, DHL, Deutsche Post, CH Robinson and UPS are direct competitors. Clarkson and James Fisher seem to be relatively smaller. Okay, now for the fun part. Now we're going to look at the stock analysis itself. We're going to start with the balance sheet test. And the first of that test is the total debt to assets ratio. Assets are made up of debt and equity. Total debt to assets shows the percentage of the assets that is raised through debt. In an ideal world, debt should not be more than 40% of total assets, but this is not a hard and fast rule. Larger companies tend to get away with larger debt ratios because of their market dominance. So unsurprisingly, UPS is the worst, with 44.4% of the assets being debt and the rest is equity. FedEx is third with 32.32%. James Fisher is second with only 21.82% in debt. And Clarkson is first with no debt to its name. And next is the solvency ratio, which looks at how much a company's earnings covers all its liabilities. In reality, this wouldn't be by much, but ideally should not be less than 20%. Companies have to make repayments of the debts plus interest, as well as servicing outstanding liabilities, so it's sensible to have income which is not less than at least 20% of total liabilities. But again, this is not always the case. So let's take a look and see how each company fares in this category. Fedex is the worst, again unsurprisingly here, with its annual operating income amounting to only 10.74% of its total liabilities. UPS is third with 17.5%, Clarkson in second with 22.92%, and James Fisher in first place with 27.21%. So we're looking at the total overall. We have both Clarkson and James Fisher in joint first, and UPS and Fedex joint last. The next test is the profitability test, and on here the first metric we'll be looking at is the revenue growth rate. This is the rate at which the gross revenue or top line income has grown year over year for the past 4 years. I like to see a growth rate of about 10% or more, but that is not always sustainable long term realistically unless it is a growth stock. Perhaps 5% year on year is not a bad growth rate, and probably more realistic to expect from a dividend stock. So looking at this, we have Fedex, which is 11.43% with the highest growth rate. And next we have James Fisher with 8.64% growth rate. And then we have UPS in third place with 7.18%. And in last place we have Clarkson with 3.81%. So the next metric to look at is the return on asset. This tells us how much all the asset is generating. 10% return on asset is ideal. That basically means that for every asset that we have, the income is 10% of it. For this, UPS is top with 9.58%. James Fisher is second with 7.43%, and Clarkson third with 5%. Fedex with a measly 0.99% return on assets. Pretty shocking for a company that has a great deal of assets, but yet only generating so few in income. So overall, UPS and James Fisher are joint top, and Fedex is third, and Clarkson is last for the profitability test. Now we move on to the next one, which is our dividend safety test. The first metric on there is the dividend growth rate. This is the number of years the dividend has grown year over year. So at the top we have James Fisher with 24 years of growing its dividend year over year. That is seriously impressive. Then next we have Fedex with 17 years of growth year over year. Then UPS in third with 10 years of growth year over year. Clarkson hasn't grown his dividend at all. Next we have the payout ratio, which tells us the percentage of a company's earnings that is paid out as dividends. At the top we have James Fisher with 33.18%. That's how much he pays out as a percentage of its income in dividends, which is quite good. UPS is next with 62%, relatively high but not too bad. Then we have Clarkson in third, which is 75.5%, again relatively high but not too bad, still relatively safe. And then the worst is Fedex with 126.48% of its income being paid out as dividends, which is totally shocking. That really isn't sustainable. And when you look at the fact that it's been growing its dividends for 17 years, it obviously has some sort of motivation, or it's going to be compelled to want to continue to increase its dividends year over year. And at the rate of 126% of income, where is it going to get the money to raise it? Potentially from debt, again, which is not a good sign. And then the final metric in the dividend safety category is the dividend yield. This tells us how much we get in dividend as a percentage of a share price, and UPS is at the top with 3.17%, which is really good in terms of dividend rate. It's not the greatest, but it's not bad in comparison to the rest of the people in this group. Next up, we have Clarkson with 2.77%. And then in third place, we have James Fisher with 1.71%. And right at the bottom, we have Fedex with 1.56%. Again, really shockingly low dividend yield, considering it's pretty much paid out all of its income, as well as pretty much all of its, more than its income. So that's really just not good. And you can be quite sure there's a very high likelihood of the company either cutting its dividend in the future, or if not, taking on more debt to service its dividend payments. So that is not a safe dividend at all. So overall, for the dividend safety category, we have James Fisher at the top with 28 points, UPS in second place with 27 points, Clarkson with 24 points, and Fedex at the bottom. Then the next category is the final category, which is the valuation test. The first of which is the PE ratio. The PE ratio tells us how much the price is greater than the company's earnings. The lower, the better. So right at the top, we have UPS with 21 times its earnings, James Fisher with 22 times its earnings, Clarkson with 27 times its earnings. Fedex is an astonishingly 75 times earnings. Considering Fedex is not a growth company, I'm not sure there's any justification for that, but there we are. The next metric is EV to FCF, which is enterprise value to free cash flow. It's pretty much the same as the PE ratio, but includes debt and cash. Now, just to give you a bit of an example, take two companies, Company A and Company B. If both have a market cap of £100,000, but Company A has £50,000 in debt and zero cash, whereas Company B has zero debt and £50,000 cash, in effect, what you'll do is you take the debts and add it to the market cap and deduct the cash from that figure. That would mean that Company A would end up costing £150,000, whereas Company B would only cost £50,000. That's because Company B has no debt, and so you're not adding anything to that value. And it has cash of 50k, and you don't have to pay for cash because you already own it, and that means you're deducting £50,000 from the 100k valuation, which leaves you 50k. On the other hand, for the first company, you're having to add £50,000 debt to the market cap, because although you're paying 100k in market cap, you're also inheriting or buying an additional debt of 50k, which also has to be paid for, thereby raising the value to 150k. So that in itself shows the importance of using enterprise value as a form of valuation, as opposed to simply just using the market cap on its own. Now, a similar story can be said for free cash flow. Free cash flow is better than net income, as it is less susceptible to manipulation, especially depreciation, which is one of the most arbitrary numbers in accounting. It simply isn't based on any sort of reason whatsoever. Companies can literally choose any figure and basically decide to calculate the depreciation on the basis of a figure that's been plucked out of thin air, and that's no exaggeration. And the same goes for amortization. So what happens in the case of net income is that to work out free cash flow, you add back depreciation, amortization back to net income, and then you also deduct capex, which is the actual physical expenditure made by the company in that particular year for particular expenses, machinery, etc. So that really shows the true value of the income that's available to the company for that year, from what is generated from its business operations, and that is free cash flow. It's a far better figure than net income. Having said all that, so all in all, it's a better representation than the PE ratio. It's a truer figure of what you're paying for a company than just looking at the PE ratio. So the closer a company is, EV FCF is to a PE ratio, the more truer and more reliable you can rely on the company's figures, and the further away from it, then you should be more cautious. Certainly you'll be looking to take the EV FCF figure as opposed to the PE ratio. So looking at this figure, we can see that Clarkson has 26 times its free cash flow, UPS 43 times free cash flow, and James Fisher 56 times free cash flow, and FedEx, well, it's a lost cause. It's got negative free cash flow, and that really tells its own story. Now, the final metric I'm using for the valuation test is the discounted cash flow. I'll be using the Guru Focus discounted cash flow calculator, and that's how I've come up with the figures that you can see on the screen. And basically all it tells me is that when you take the true fair value for each of these businesses and you deduct that from the actual share price or the current share price, the difference is the margin of safety. Now, ideally, if the fair value is less than the current share price, then that seems to suggest that the company is overvalued. If the fair value is greater than the current share price, then that would suggest that the company is at an undervalue. Now, in this case, it would appear that all of these figures are negative. That means that the share price is greater than the fair value by 79% in the case of Clarkson, 94% in the case of Fedex, 28% in the case of James Fisher, 53% in the case of UPS. So James Fisher is of course top, UPS is second, Clarkson third, and Fedex of course is last. So overall, for the valuation test, you could see that UPS has come up as top, Clarkson is second, then we also have James Fisher third, and FedEx last. And now, finally, for the overall scores, take into consideration all of the various tests above. Now, to give you the final results, drum roll please, and we have James Fisher in first, and we have UPS in second, and we have Clarkson in third, and FedEx, unsurprisingly, last. So my final thoughts, UPS and James Fisher really aren't bad buys, but for my money they're a bit overvalued. But if you were dollar cost averaging long term, then both have really good dividend safety records, as can be seen from this video, and may well be worth the buy. But I think what come out the most is that FedEx is probably a trap. I couldn't even call it a value trap, because there really isn't much in terms of value. It's really rather overpriced, but at the same time, it doesn't look like a stock going anywhere anytime soon. I could be wrong about it, but certainly it will be a stock that I will be staying well away from, given number of reds all the way through pretty much the whole thing from top to bottom. But please do let me know what you think about this video. Is there anything else you'd like me to cover whilst doing these stock analysis? Are there any other metrics you'd want me to look at? Does it come across clear? I mean, any feedback would be really helpful. I'll be really grateful for your comments, and please do subscribe. My aim is to pretty much cover all of the sectors currently on Freetrade, so there'll be many more videos like this to come. But of course, I'd like to make it more interesting if possible, and if there's any suggestions to make it more interesting and to draw more people, then please let me know. But anyway, thank you very much. Peace.